The Federal Reserve Bank of New York reveals over 7 million Americans are 3 months behind on auto loan payments, surpassing levels seen in 2010 and post-financial crisis. Hey there, welcome back to Finance Zoom. In today's video, I'll explore why Americans face car loan challenges and uncover contributing factors to this concerning trend. Let's hear this out.
Things are getting better as the unemployment rate goes down and wages continue to grow. But then there's a part of the population where jobs were hard to come by and wages have stagnated for 2 decades. And while things look a little bit better now, many people are still struggling to pay their bills. And that's why we have record numbers of Americans who are on the verge of having their cars repossessed.
According to the Federal Reserve Bank of New York, although the job market is improving with lower unemployment rates and rising wages, a significant portion of the population has struggled with scarce job opportunities and stagnant incomes for 20 years. Despite recent positive developments, many Americans still struggle to cover their bills, resulting in record numbers of individuals on the verge of repossessing their cars. This serves as a reminder of the distinct economic strata that characterize the United States. While some individuals enjoy considerable success, a substantial middle class perseveres amidst improving job prospects and growing wages. However, a population segment remains where job opportunities have been scarce and wages have stagnated over the last 2 decades. Despite recent improvements, many continue to grapple with financial obligations, leading to a record number of Americans on the brink of car repossession. It's concerning that most of those facing this issue are under 30, with car repossession potentially harming their credit scores for years. This could hinder their access to future loans for homes, cars, or rentals. Unlike home loans, auto loans have seen fewer post-financial crisis regulations, allowing exploitative practices. Technology has also streamlined repossession, with cars now tracked nationwide. These economic vulnerabilities show ongoing challenges despite growth. 2023, the average monthly new car loan payment will be $725, up from $650.20 in 2022. Used car loan payments average $516, up 2% from last year. However, car buying experiences often need more positivity due to rush processes. Complaints and lawsuits against lenders have surged over the years due to alleged illegal practices, eroding trust. Before delving into the reasons behind this topic, look at this statistical graph indicating that vehicle financing and leasing rates are currently at their highest levels in years. According to CNN Business, annual percentage rates have significantly increased over the past 2 years. In particular, the average loan rate to lease a new car or truck has more than doubled since March 2021. High loan rates mean monthly payments are soaring as well. In March, the average monthly payment for financing a new car hit $730, the highest on record, according to Edmunds. The average payment for financing a used car is now $556 per month, up a staggering $147 from June 2020. More new car owners are paying as much as $1,000 a month. In January 2019, new car payments over $1,000/month made up roughly 5% of sales. In March 2023, only 4 years later, 4-figure monthly payments ballooned to 17% of the new car market. Next, the percentage of vehicle payments exceeding $1,000 a month has tripled in 4 years. Around 17% of individuals with new car or truck loans now face monthly payments of $1,000 or more due to higher prices and increased interest rates. Some high-payment buyers opt for short-term loans with substantial down payments, but these remain a small segment due to upfront costs. Most $1,000 per month car loans stem from high interest, longer-term loans driven by rising car prices, and difficulty securing lower interest rates. The prevalence of long-term loans, lasting 6 to 7 years, has risen from just 1% in 2004 to 30% of the car and truck loan market. Lastly, here's the average length of car and truck loans. Loans lasting 6 to 7 years represented only 1% of the market in 2004, but now make up 30% of car and truck loans. Opting for longer loans means lower upfront costs for buyers, but interest rates accumulate significantly over time. For instance, with a 70-month loan for a $28,700 used car at the current average rate, interest payments could surge by 38%. In contrast, shorter loans of 2.5 to 3 years have far lower interest costs. The pressure is greatest on lower credit consumers, who face interest rate shifts, inflation, vehicle prices, and potential credit-related premiums. Despite these challenges, the market is rebounding from the post-pandemic supply chain crisis, with Q1 of 2023 new vehicle sales up 5.7% compared to the same period in 2022, according to Cox Automotive data. However, the growth is primarily seen in higher-income households. Now let's talk about how auto loans work. Like any other loan, an auto loan provides a lump sum for purchasing a car. You gradually repay this amount, often with monthly payments containing interest. After approval and possibly a down payment, you can drive your new or used car. Remember, full ownership depends on consistent payments, including interest. Until the loan is cleared, the lender holds the car's title and can repossess it for missed payments. Did you know there are two types of lenders? Direct lenders are local banks, credit unions, or online lenders. Approval from them lets you shop as if you were paying in cash. Indirect lending involves dealer-arranged financing at the time of purchase, with about 80% of auto loans following this route. Whether you buy new or used cars, or use direct versus indirect lending, your interest rate and loan terms depend on the lender's confidence in repayment. They assess your financial health, including income, expenses, and credit score, shaping the terms they offer.
Our primary goal is to put customers in financial products that they can afford.
According to the CEO of Chase, the primary goal is to ensure that customers are provided with financial products that match their financial capabilities. Chase Auto, for instance, focuses on serving consumers with credit scores of 620 and higher, and the average credit score in this segment is around 700. Collaborating with Toyota Financial Services, known for catering to those with high credit scores, further emphasizes the commitment to delivering quality financial services. Peter Muriengi acknowledges the importance of inclusivity and suggests that while higher credit scores are targeted for stability, individuals with lower FICO scores willing to make larger payments should also be considered. This approach aligns with the ethos of responsible lending and comprehensive customer support.
In 2022, 5.3% of total auto financing came from Toyota Financial Services. 4.4% came from Capital One Auto Finance.
In 2022, Toyota Financial Services handled 5.3% of auto financing, while Capital One Auto Finance managed 4.4%. Their success comes from strong partnerships and a focus on customers. Toyota's financial services mainly involve financing for dealers and customers, showing a 21% rise in sales revenue for 2023. The market faces risks due to the chip shortage and high inflation. Over half of auto financing relies on non-bank firms for short-term funding, making them vulnerable to crises. Rising interest rates led to a 15-year high average new vehicle loan rate in early 2023, while elevated car prices due to supply chain issues added to the problem. This resulted in higher loans and debt, impacting lower-income consumers, especially those with credit scores below 620 due to the Fed's rate hikes. Allegations of discriminatory practices by lenders raise concerns, like Chase's partnership with Subaru. Indirect lending involves hidden markups, creating transparency issues. Chase Auto is addressing these allegations. To ensure compliance with regulations, thorough tests and reviews are conducted to safeguard consumers like you. The FTC proposed rules to address unfair auto financing practices, but recent developments show potential delays in the new legislation. Meanwhile, Advocates emphasize the need for protective programs and transparency. Transparency regarding loan rates is vital. You should access rates directly from lenders, whether online or at dealerships. Protecting yourself is paramount. Experts recommend shopping around, checking credit scores, and seeking pre-approval online or through local credit unions and banks for potential deals. Credit unions offer lower rates at around 6%, while banks hover at 7% or 8%. Digital marketplaces provide resources to understand rates and terms better. When buying a car, compare dealers for rates and avoid high-interest options. Take your time and remember, your voice matters. Real change demands a political commitment to consumer protection. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Soon channel. I'll see you in the next video.